Something is happening in the silver market that should not be possible. Prices are rising, inventories are collapsing, and yet every official chart still insists the system is stable. But behind the scenes, the truth is leaking out. COMEX registered silver has fallen to levels no one alive today has ever traded through. South Korean banks abruptly halted silver sales without offering a single public explanation. And the futures curve, normally smooth and logical, just inverted into backwardation, meaning silver today is more expensive than silver tomorrow. Markets only behave like this when fear enters the bloodstream, when people who usually trust paper contracts begin demanding the metal itself. So here is the uncomfortable question. If silver truly becomes unavailable, does the price even matter anymore? Stay with me. By the end of this video, you will understand why silver is entering its most dangerous stage, the point where it stops being a commodity and becomes something far more rare, unobtainium. Silver is not moving randomly. It is following a historical pattern that has played out in every metal crisis of the last 50 years. Gold in 1971, palladium in 2001, nickel in 2022. In every case, the market crossed the same 5 stages, quietly at first, violently at the end. Stage 1, liquidity masking reality. Paper promises create an illusion of abundance. Stage 2, silent depletion. Inventories shrink year after year. Stage 3, industrial collision. Real-world demand overwhelms the paper system. Stage 4, break of convertibility. Paper can no longer be exchanged for metal. Stage 5, physical revaluation. The metal rewrites its own price. This is not theory. It is a forensic map of how markets fail when the physical world refuses to obey financial engineering. And right now, based on every available data point, silver is no longer in stage 2. It is deep inside stage 3, pressing dangerously close to stage 4. If you're watching this from anywhere in America, this is not just a story about a precious metal. Silver is embedded in nearly everything that defines modern life. Your smartphone depends on it. Your electric vehicle cannot function without it. Solar panels, medical imaging, semiconductor fabrication, 5G infrastructure, missile guidance systems, every one of them consumes silver in ways that cannot be substituted or delayed. A silver shortage does not stay in the financial world. It shows up in your monthly electric bill, in the price of your next car, in the rising cost of technology that surrounds your daily life. It pressures inflation, squeezes disposable income, and eventually reshapes retirement portfolios as the cost of essential technology rises faster than wages. And here is the unsettling truth. Even if you do not own a single ounce of silver, you will still pay the price when the shortage hits. The pattern that governs every metal crisis is not abstract. It unfolds like a slow-moving disaster, each stage predictable, each stage feeding the next. It begins with a comforting illusion. The market appears liquid, deep, and well-supplied because paper contracts, futures, derivatives, ETF shares, are stacked so high that no one questions whether the underlying metal truly exists in matching quantity. That is stage 1, liquidity masking reality. Then the quiet drain begins. Stockpiles fall, mining output stagnates, industrial demand climbs. But because everything still trades smoothly on screens, no one notices, or no one wants to. That is stage 2, silent depletion. Stage 3 arrives when the physical world no longer cooperates. Solar manufacturers, electric vehicle producers, medical suppliers, they need metal, not a contract. Their orders collide with shrinking inventories, and the illusion begins to crack. Premiums rise, delivery delays stretch, the paper market starts to sweat. Stage 4 is the breaking point. The moment the market cannot reliably convert paper promises into actual metal. And stage 5 is when the physical market sets a price the paper market cannot contain. That is the reset. That is the moment silver becomes unobtainium. Every credible data set from 2024 and 2025 suggests the United States is trapped between stage 3 and stage 4. To understand how fast a metal can slip out of financial control, you have to revisit a crisis most people barely remember. In the late 1990s, the global automotive industry depended on palladium to build catalytic converters. Russia controlled the majority of the world's supply, and for years it exported the metal with machine-like regularity. Automakers built their production schedules on the assumption that Russia would always deliver. Traders built their futures positions on the belief that supply would remain stable. Everyone trusted the system. Then, without warning, Russia slowed shipments. Officially, it was a bureaucratic delay. Unofficially, no one could get a straight answer. Weeks turned into months, and factories across Europe and North America began to panic. They did not need a contract. They needed metal. The futures market suddenly became irrelevant. Paper traders could celebrate profits on screen, but they could not build a single functioning catalytic converter. As inventories drained, the price exploded. Palladium did not rise moderately or gradually. It launched upward with no regard for technical models or historical averages. At the peak, it had surged more than 260%. Some automakers paid whatever price they had to. Others halted production lines entirely because there was no metal available at any price. Futures traders who had shorted the market were obliterated, not because they miscalculated price direction, but because they miscalculated reality. They assumed physical metal could always be delivered. They were wrong. The lesson is brutal and simple. Metals do not behave like equities or bonds. They obey geology and geopolitics, not spreadsheets. When a real-world supply chain snaps, the paper market becomes a spectator. The crisis enters stage 4, the break of convertibility, and price stops being a negotiation. It becomes a warning. Silver today sits dangerously close to the same fault line. Backwardation, inventory drawdowns, and industrial desperation all echo the palladium crisis. When the industrial world needs metal, paper cannot save it. And once the physical shortage becomes undeniable, the reset follows quickly, violently, and irreversibly. No discussion of metal market breakdowns is complete without the moment the global monetary system snapped in half. In 1971, foreign governments rushed to exchange their dollars for physical gold. The United States Treasury faced a simple mathematical problem. It did not have enough gold to honor every claim. The paper promises were larger than the physical supply. The imbalance was exposed. President Richard Nixon closed the gold window, ending convertibility. Overnight, the world shifted from a system anchored to metal to a system anchored to confidence. Gold did what it always does when released from artificial suppression. It revalued violently. Within a decade, its price multiplied 24 times. Silver's story in 1980 is different in detail but identical in structure. Two brothers from Texas, Bunker and Herbert Hunt, believed the dollar was decaying. They began accumulating silver, first modestly, then aggressively, then relentlessly. They bought contracts. They demanded delivery. They drained physical supply. By 1979, they controlled 200 million ounces, half of it in their own vaults. The price rocketed from $6 to nearly $50. Wall Street panicked. COMEX, facing the risk of running out of deliverable metal, changed the rules mid-game. Long positions were frozen. Margin requirements were raised. The system defended itself the only way it could, not by allowing the market to function, but by preventing it from functioning. When silver collapsed on Silver Thursday, the Hunts were ruined. But the deeper message was not about two billionaires losing money. It was about the fragility of a financial system built on the assumption that paper and metal are interchangeable. They are not. When physical demand overwhelms paper liquidity, the system bends, then breaks, then rewrites the rules to save itself. That was 1971. That was 1980. The alarming part is not that history repeats. It is that the same structural vulnerabilities exist today on a much larger scale, with far more global consequences, and with a market that is already showing early signs of fracture. In March 2022, the London Metal Exchange, the oldest commodity exchange in the world, witnessed something it had never seen before. Nickel, a metal that rarely makes headlines, detonated. For years, traders assumed the nickel market was deep enough, liquid enough, and predictable enough to support massive short positions. After all, there was always plenty of metal, on paper. But when geopolitical tension disrupted supply chains and a major producer found itself on the wrong side of an enormous short bet, the illusion cracked. Prices did not rise. They erupted. Nickel shot past $100,000 per ton in hours. Traders were wiped out. Clearinghouses panicked. And in the most shocking move of all, the LME stepped in and did the unthinkable. It canceled trades. Billion-dollar positions simply vanished. The exchange did not protect free markets. It protected the system from its own promises. Why does nickel matter to silver? Because nickel's market is small compared to silver's industrial footprint. Yet a single supply shock was enough to break its financial infrastructure. Silver's supply chain is far more strained, far more global, and far more essential. If nickel could unravel an entire exchange, imagine what happens when a metal the world actually relies on, solar, energy, medicine, defense, enters the same pressure zone. Nickel showed what stage 4 looks like. A market where convertibility collapses and the rules bend to save the paper system, not the participants. Now, look at where silver stands today. Backwardation has become frequent, a clear sign that buyers value immediate delivery more than future promises. COMEX registered inventories hover at their lowest level in over 40 years, shrinking even as demand intensifies. India is importing silver at a pace never recorded in modern history. China is tightening export controls and redirecting domestic supply to its own industries. And in February 2025, major South Korean banks publicly suspended the sale of physical silver, an unprecedented act for institutions that normally capitalize on rising demand. These are not isolated disruptions. They are signals. They are the same early tremors that preceded gold's revaluation in 1971, palladium's explosion in 2001, and nickel's implosion in 2022. We are no longer talking about theory or historical analogy. We are living in the moment where past patterns begin to activate. The 5-stage pattern is not a narrative device. It is a diagnostic tool. And when we apply it to the silver market of 2024 and 2025, the alignment is undeniable. Stage 1, liquidity masking reality, has defined silver for more than a decade. The financial world created far more claims on silver than silver itself. For every ounce of metal sitting in a vault, there are 50 to 100 ounces promised in futures, derivatives, and ETF shares. Most investors never notice the fine print allowing cash settlement instead of metal. A promise that can be fulfilled with dollars is not the same as a promise backed by ounces. The system relied on no one asking for delivery. Stage 2, silent depletion, began long before analysts admitted it. 7 consecutive years of structural deficits drained global stockpiles. Industrial demand kept rising while mine supply stagnated. Ore grades declined, capex budgets shrank, and new projects struggled through permitting regimes that can take a decade to navigate. The result was a quiet erosion of the world's silver cushion. And because financial markets only looked at paper liquidity, the warning went unnoticed. Then came stage 3, industrial collision, the moment when the physical world crashed into the financial structure. Solar manufacturers required record amounts of silver as global capacity expanded. Electric vehicle producers consumed 2 to 4 times the silver of traditional automobiles. Military systems, satellites, radar arrays, medical imaging facilities all surged their consumption. These industries cannot delay production. They cannot substitute efficiently. They need metal now, not later. As their orders increased, inventories fell faster than mining could replenish them. Delivery times stretched, premiums separated from spot. The paper system began losing touch with the real world. Today, the market is brushing up against stage 4, the break of convertibility. This is the phase where the financial system struggles to honor its own obligations. Futures contracts are increasingly settled in cash. Dealers quote one price for paper and a much higher price for physical. Backwardation no longer appears as a rare event, but as a structural symptom. When spot is consistently more expensive than futures, the market is telling you the truth. It values real silver far more than promises of future silver. If stage 4 completes, stage 5 follows automatically. Physical repricing. In this phase, the physical market sets a new price independent of futures. It is already happening quietly. While official spot sits in the 60s, dealers charge $80, $90, even $100 for guaranteed delivery. Industrial buyers secure supply through private contracts at premiums never reported on financial networks. Paper silver becomes a reference point, not a reality. This is not an end of the world scenario. It is an end of the illusion scenario. And the illusion that paper and physical are interchangeable is already crumbling. Every sign that has warned previous generations, the drain of inventories, the rise of premiums, the breakdown of futures pricing, has returned. Silver is not entering a speculative bubble. It is entering a supply crisis. And once a metal crosses from shortage into scarcity, markets do not correct. They transform. A silver shortage is not a financial inconvenience. It is an economic choke point, one that touches nearly every corner of modern American life. When the metal that powers solar panels becomes scarce, the cost of renewable energy rises. Household electricity bills start creeping upward. When the metal inside electric vehicles surges in price, manufacturers pass those costs on to buyers, and suddenly the price of the car you plan to purchase next year becomes unreachable. The implications stretch even further. Semiconductor production relies on silver's unmatched conductivity. Radar systems, guidance technology, medical imaging machines, each depends on it. A shortage does not simply slow production. It reshapes national security. It forces the military to rethink procurement. It tightens the supply chains that keep hospitals, research labs, and infrastructure running. But the most overlooked consequence is psychological. Inflation driven by technology shortages does not show up where people expect it. It hides inside the things Americans rely on: appliances, energy, mobility, communication. Retirement portfolios, especially those built around predictable inflation assumptions in 401ks, suddenly face pressure as the cost of essential technology rises faster than expected. What was once a safe projection becomes an uncomfortable question mark. Silver does not need to hit $100 or even $50 to trigger fallout. It only needs to remain scarce long enough for the real economy to feel the weight of missing metal. In a world built on electronics and electrification, the absence of silver is not just expensive, it is destabilizing. There is a myth that silver markets fail because the system is broken. But that is not the truth. The system works exactly as it was designed to. It prioritizes liquidity over reality. It rewards paper stability over physical scarcity. It delays the truth for as long as possible because the truth is inconvenient. There is not enough metal to satisfy the promises made in its name. The coming disruption is not a malfunction. It is a scheduled confrontation between a financial architecture built on confidence and a physical world governed by limits. And when the two collide, it is always the physical world that wins. What looks like a price spike is really something else. It is the moment a market stops pretending. It is the moment reality gets priced in all at once.